We once had a CEO that we backed get pushed out by the employees, and a very young guy was like 24 years old, borrowed money from a crypto whale, which we later found out was Sam Bankman-Fried. And Sam Bankman-Fried lent this guy $15 million, and he paid off me, our fund, Graycroft, Tim Draper, Adam Draper, Fen Bougie, all these major investors. He paid us off. We got a 1.5x premium plus the 6%. So it's like 1.68, return on a company that 30x revenue. So we should have been looking at a minimum of 30x return. Wow. And then we found out that Sam Bankman-Fried had lent him money to buy a villa in the Bahamas. And so like this guy's going to be 50 before he stops talking to lawyers, to stay out of jail. But like, it was just, I just thought I'd close on an example of like, I honestly wish that had been a priced round, and don't give this available option of just pay us all out and be discommunicated from the venture capital and, community. Yeah. Hello, and welcome to Fireside with VC. My name is Andrew Romans, and today we have Daniel Zimmermann from WilmerHale, who is a legendary lawyer I've known for something like 20 years, but he's been doing deals in Silicon Valley and around the world for a very long time. So perfect person to do this episode with us, where today we're going to focus on understanding everything you need to know, but we're afraid to ask about a convertible note. So, and even the evolution of that. We're then going to talk about everything you need to know, but we're afraid to ask about pre-money safes and post-money safes. So I deal with a lot of people, from founders to advisors to VCs, that blow my mind, that are misunderstanding a lot of key things. And so we're going to kind of educate, Daniel's going to walk us through these things. But then if you stick around, we're going to get into a much more nuanced, deeper conversation about what these really mean. So, YC might be pushing this on you, but it's only in the end at M&A and stuff, or in conversion, that you find out what irreversible decisions you've actually made. So we're going to be talking about convertible notes, pre-money, post-money safes, and priced rounds, and what they really mean for founders, what they mean for your employees, what it means for your angel and early venture capital investors, and how it plays out in the end. So, Daniel, thank you so much for joining us. Great to see you again.
Good to see you. Thank you.
So, Daniel, maybe give us a background. I mean, you and I talk about this stuff all the time, but maybe explain, where did the promissory note come from, or explain the background of a convertible note and how it's come into use over your 3 decades of advising VCs and startups on this stuff.
Yeah. So, Andrew, thank you. I think the interesting part of here is that especially startups and emerging growth companies have a sort of a unique way of funding themselves, right? So on the one hand, they're always looking for investors, and investors want to put money into these companies, but there's different ways of putting the money in. One would be, of course, an equity financing that you mentioned earlier, but equity financings have become relatively sophisticated, I would say, and also the source of, much chagrin from a fee perspective, because they're complex, they take longer, they cost money. I mean, if you look at currently the NVCA, the National Venture Capital Association model docs, which everyone can access and which are sort of the basis of most equity investments, you'll see, especially when you take the time to actually walk through them and read the footnotes and all the different potential variables, that, there's a lot there. And certainly most entrepreneurs are not, they didn't go to law school, for one, or some of them did, but a lot of them didn't. And they're not really willing to step into this bee's hive of very complex and again, an expensive process. And most importantly, I think the reason why we are using those convertible instruments that you just described, the convertible notes or the safes, is because we really don't know early on, especially when we're dealing with early stage companies, what the value of the company is, what the valuation is. And because of that, you're trying to punt as much as you can, or kick the can down the road, if you will, from a perspective of trying to decide what percentage ownership should I take as an investor, and what, how do I essentially document that and memorialize that. So the convertible note was really something that people have been using for a long time. And so when I first started, which, as you said, it's been a couple of years ago, and we, at that point in time, we really try to figure out how to quickly put money into a company without burning too much on transactional costs. And one way was to basically say, well, why don't we structure it such as a loan? Why would we structure it as a loan? So it's a promissory note. It's really a loan, but with the feature that upon what I call a qualified financing, a particular amount of money that's coming into the company on a bona fide, in a bona fide financing, that note would convert on predetermined terms. And so it's kind of a hybrid, if you will. On the one hand, it's, the note holder is an investor, is actually a creditor, because there is money that potentially would have to be paid back. And all depends really on whether or not the company is able to raise money on a particular, on a particular amount of money in the future. And also, and this is important, and I think that's a big difference between the promissory note and the safe, prior to a particular date, which we call the maturity date. And the maturity date is something that a lot of lawyers and entrepreneurs have been just, dealing with for decades, and which has been looming over them almost like a sort of a Damocles sword of sorts, that, if I need to raise money before then, because if I don't, I have to go back to these investors, and they potentially want more, they want some warrants, or they want to sweeten their terms, or frankly, they just want their money back. And so, the promissory note has been that instrument that has worked for many, many years, but it really wasn't really a perfect instrument, because I mean, for the companies and for startup founders, because you knew that there's potentially that threat of having to pay the money back. So in other words, I would say maybe, a promissory note holder is not in your boat yet, is not really in the company yet, because they could potentially ask for the money back. And there are features, by the way, in equity financings where the same thing happens, like redemption rights, but we're not going to go into that right now.
Yeah.
But typically, you could ask for the money back. So that's an important feature in a promissory note. Now, the other maybe less important feature is interest. So anytime you give someone a loan, there's actually a tax issue around that. You have to at least charge what we call alternative federal rates, which means that, they're published on a monthly basis, but there's a certain minimum amount that you need to actually raise, because that is going to be deemed income to you.
Which, by the way, I've seen convertible notes with such a low interest rate that I believe it was illegal. But really fast, and then we'll get deeper into things. What are the main moving parts? So we've got maturity date and interest rate. What are the big features that you have to fill in on a convertible note?
Yeah, so the thing of the convertible note typically, of course, will be, the qualified financing, the size of the qualified financing.
So that's what triggers conversion of debt into equity.
Correct. Yeah, exactly. And it used to be like always $1 million, but it could be much more, right? If you raise like $3 million in debt, of course, in convertible notes, then typically the qualified financing will be maybe 5 million or 10 million or more.
Right. So it's specified in the note that it says what will trigger this debt into equity is a bona fide financing, and it's qualified as a minimum of, and you enter that amount. It could be 1.5, could be 1, could be 4 million, whatever that is. And so that's triggering conversion.
That's triggering the conversion.
That's the detail of what's in the bona fide, qualified financing.
Yep. And that's the beauty of it, because then, the note holder or investor can't come back and say, well, I don't want it to, I want my money back. No, I held up my side of the bargain as a founder, or the company. we raised money on this, on a particular valuation, and we get to that a little bit
in advance of the maturity date coming into effect. So if the maturity date happens in advance of the bona fide financing, and this is what, when I first saw the SAFE, I said the SAFE is great because it removes this maturity date where some touristy investor can misunderstand that it was an equity financing that was trying to get people to agree on valuation and keep transaction costs to zero. And they think they're going to get their money back. So by removing that maturity date was good. But then again, as I get older, I kind of like the idea that this founder is thinking I'm highly motivated to convert, to actually complete a bona fide priced round financing. And a lot of good things come to us as investors for that, by converting that debt before it has a chance to ask for repayment at the maturity date. Plus, so the principal plus interest. What are the other moving parts in a convertible note that they all have?
So clearly, then of course you want to know, how does it convert, right? Is it, for example, does it just convert on a discount, for example? And in the old days, if you will, it was very, very, very kind of customary to have maybe a 20% discount and no cap. Now that has changed over time, and in particular because the venture capital industry, if you will, broadly speaking, and angel investment and seed financings have become just a little bit more professional and institutionalized, if you will. And there are formulas and there's particular metrics that, of course, those early stage investors also need, and they can't, for example, if you, for example, only have a discount, help the company get to a very high valuation, and then the big beautiful prize at the end is a 20% discount.
Right. So the example, so key moving parts are that the convertible note is an instrument that allows the startup to quickly get cash in the door from multiple people. If there was a debate about what's the valuation on a company with no revenue and very few employees and pre-product, you say, we're going to kick it down the can and it'll convert when these more professional VCs show up and set the valuation. And so you're going to have a discount rate, and 20% is the industry standard. So if you're above 20%, you almost look desperate. And if you're below 20%, you almost look like you're trying to make your financing unattractive. That's my view. And so that's the discount rate. And so if you raise your next round at $10 million, the debt plus the interest will convert to buying that number of dollars of equity at a 8 million pre-money valuation, 20% lower than the 10 million of the pre-money now that we kicked it down the can. Now, I think that was the 80s and 90s, that we were so unprofessionalized that you couldn't get all these people, these diverse people, rich people in a coffee shop in San Francisco to agree on the valuation, where I would argue now people that are active investing as their full primary business activity, or even on the side, are professional enough to know the market, and we do know the valuation. We're not doing it to get us all to agree. We're doing it to keep the bill to WilmerHale as low as possible. And if you're only raising $250K, you don't want a material percentage of that going to legal transaction costs. But so explain what the cap is. So the cap actually puts in the valuation.
Right. So very, very well. And I mean, exactly. So the 20% discount, seems all great. Like, if you just have a normal type of progression of things, and the company raises money quickly, maybe you say 20% is a great discount, especially, for example, 6 months before an actual financing. But sometimes it actually takes time, and you do raise a bit of money, and that money then you would like to have some certainty as to how it converts, and gives you a little bit what I would call like a it's not the right word, but we call it like an anti-dilution protection to some of sorts, where you say, I know that I'm going to convert at a particular valuation. So for example, in your what you could say here in your example, if you had an $8 million pre-money valuation conversion cap, and also a 20% discount, if the company were to raise money at 10 million, it would be the same, right? It would be exactly the same if you're raising 10 million with a 20% discount or an 8 million cap. But let's say the company now raises at 12 million with a 12 million pre-money valuation. Well, then all of a sudden that 8 million cap gives you a 1/3 discount. It's much nicer than
Right.
a 20% discount, as an example. Now, again, we're not putting into calculating out like exactly how that all plays out, because sometimes it depends very much what the terms of the equity financing are. For example, how big the option pool will have. Unallocated option pool has to be prior to closing.
But Daniel, before we get into those details, I just want to make clear that you have uncapped notes, which are bad in my opinion, and I'll explain in a minute why I think that is. But you basically have a cap, which is we are setting a valuation. We're saying, we're investing in an early company. We have a cap of say $10 million, but we also have a discount rate of 20%. And then there's an interest rate that is typically 6%, in normal times, in my view. And we can talk about where the market is on that.
Sure.
But
Sure.
So that means if the company raises money below the cap of 10 million, then the investor who lent money through the convertible note instrument will convert it at 20% discount to whatever was less than a 10 million pre.
That's correct.
And that's a reward for saying, hey, I invested when it was early. You came in later when there was lots of revenue and it wasn't so risky. So you can invest and buy shares in the startup at a higher valuation. I was in a year or 2 or 5 years ago, maybe even before it was. Now, if you're Lady Gaga and you invested an uncapped note into a startup and you've got more Twitter followers than Obama, and you invest in the company on an uncapped note and it's got a 20% discount, you tweet 15 times a day about how great this is, and the whole world of Lady Gaga fans download this app, and then it becomes bigger than Skype, and it raises money from Bessemer at 100 million pre. Lady Gaga invests in a pre-revenue company. She brought the rain. She made it rain with revenue, and she converts at an 80 million pre, when she could have put a cap of 8 or 10, made it rain, and then she converts at a startup, early stage valuation, and Bessemer comes in when it's got, is bigger than Skype. And so I think that to invest in an uncapped note is, the more you help the company, the more you're diluting your ownership in the business. And the idea that you as a startup raise money from value-added investors means you're providing them a perverted reverse incentive to have that valuation be low, and you get diluted badly as the founder. And it's a, conflict of interest, really.
That's right. And I can't comment on Bessemer because they're one of our clients, but I will.
I love agree. Bessemer. Yeah. They'll invest early. They're big enough they can invest across the continuum from.
But I agree. No, I agree with you. I think that's exactly it. And I think, and this is why we started seeing these caps, because we had these breakout companies, these companies that just, where early stage money really helped boost the valuation of those companies, get them to that level and help them to get there. And then at the end of the day, they really just received a very small, almost token discount, which, as you said, could be unfair in some situations. And absolutely that is why we're now dealing almost always with a cap.
Yeah. So explain how the interest rate works. So let's say that I invest $100,000 on a convertible note, cap, discount rate, whatever. It's $100,000, and a year goes by before the conversion of my 100 grand. 6% interest rate. How does that play out?
Yeah, I mean, that's actually pretty simple. I mean, literally in our spreadsheet, we will calculate the interest daily, right? Depending on when the closing happens. We usually do it on a 360-day basis because it's just a little easier than 365. But that's all debatable and can also be included in the conversion documents in the convertible note, or in the safe, by the way. Not that there's no interest, of course, in the safe, but there could be particular calculations that are based on 360 days. So ultimately, what we would do is, in your example, we would calculate out exactly, if it's exactly the 1-year anniversary of the closing of the convertible note, it would be 100,000. And then 6% on top of that would be 106,000. So you all of a sudden, at that particular point in time, would have $106,000 worth of dollars that would convert on whatever terms that they would convert at, right? But now if you go to the second year anniversary, you of course have 106 of that first year, and then you would base it off of 6% off of the 106,000, right?
Right.
And again, it depends a little bit on how it's calculated, but pretty much that's how you typically calculate it. So yeah, and you would get that benefit, if you will, at the time of the conversion. That will be calculated, and we will have very complicated spreadsheets sometimes because some people close at one date, others at another date, and so it will actually have people will have different types of conversions.
Yeah, the irony is that so many different convertible notes, pre and post money saves, with all kinds of different numbers filled in on them, they thought they were keeping their legal bill low, and it's a lot of work when conversion's actually happening. And the legal bill is not just a straightforward flat fee boiler rate thing. But on the interest rate, I remember dividends are, maybe coming back in fashion, but they were completely out of fashion on a priced round, which is like a backdoor way of increasing the liquidation stack. But basically, the longer, there is a time value of money. And if somebody puts 100 grand into a company and it theoretically had a 0 interest rate, which you see in a safe, that there's no rewarding the investor for being in for, say, 5 years before Bessemer came in with a big check. And whereas if you were in for just 3 weeks and then Bessemer came in with a big check, you're just happy to be in the deal, and you don't, it didn't really de-risk in those 3 weeks. So I think that there's a little bit of fairness in the universe that an investor is getting some sort of reward if they were in it for a long time before it met milestones to be able to complete a bona fide financing described in the note. On the other hand, with the founder, that, I have portfolio companies that raised on notes that are still, like, they were extending the maturity date, and then they stopped even asking, and we're like not worried either. And I'm like, man, that interest rate is going to be material on the compound interest on an early stage, thing, on with a cap that was low, because we were in early. That, like, for the founder, a smart founder should be motivated to be mindful of this. I have interest on my credit card balance. Maybe I should pay it off and stop the bleeding of a high interest rate that's compounding. So I kind of think it's healthy that there's a reward if you're in long before the conversion, compared to I was in short, less of a reward. And on the flip side, for the founder's lens perspective, I kind of think it's good that she's a little bit motivated to go out and get this thing goddamn sorted out and put everybody on the cap table, which is better for everybody in many ways. So I think there's kind of like a healthy little bit of a motive of, don't just think you're never going to raise this bona fide financing.
No, I agree with you, and I think that fuse, if you will, is an important tool in convertible note financings, and that is a big difference. You're right, between a safe, once the money is, the safe money is in, it's in. There's like nobody can get it out. Now we can talk about some of the features as well, but the only thing I would say is, convertible notes are they can even be trickier, and they can even be even harsher, in the sense that, for example, they could even be secured. And sometimes we do see secured promissory notes, but usually not really early stage. Those usually come into play when, let's say, the company really needs funding and it's critical, and the new investors say, look, I don't want to be a safe holder. I don't want to be a convertible instrument holder except for convertible note, because I want to be a creditor in case this company goes down. But there are real assets here, and we want to take a security interest in those assets. Let's say there's a patent portfolio, and I've actually seen this play out, unfortunately, in some situations where if the company were to go into a dissolution or some sort of what we call ABC, assignment for the benefit of creditor, bankruptcy, even, bankruptcy as a formal federal proceeding, in that instance, a secured creditor, a secured note holder would actually get paid first, not just
Right.
along with all the other.
So I want to get into this, but I think it's important to understand what the safe is doing and what the safe is not doing, so that we understand what is happening in the world of convertible notes. So
Yep.
explain, so introduced to the world from Y Combinator, explain how the safe, the old pre-money safe, is different from the convertible note, and then explain why we ended up with post-money safes.
Yep. Sure. So to your point about, there is a fuse, if you will, there is a maturity date that goes away with a safe, right? So a safe is an equity investment, and
And safe stands for?
Securities against future equity.
Yeah, I thought there's a simple agreement for future equity, isn't it?
Sorry, you're right. You're
simple
right.
agreement of future equity, safe.
No, you're absolutely right. Actually, we used, that I'm dating myself. We actually used to joke around like what we call it, but you're right. It's simple agreement. But in any event, but the point is, it is an equity instrument, right? It's not a debt instrument. And then in the beginning, by the way, people were always saying, why is it a sui generis type thing? No, it's definitely equity, because the investor cannot ask for the money back. It's not a loan.
There's no maturity date. There's no interest rate.
There's no interest rate. It's basically like, hey, here's the money. I don't know yet what it is going to be. It's almost a little bit, you may have heard of blank check preferred. I know we don't have a blank check preferred because we don't actually create a new preferred class in the certificate of incorporation. But there used to be an instrument where we had a blank check preferred, where we say, we don't know yet what the actual rights and privileges are for the preferred, but we'll give you, we'll put money into this, and it can be determined later. This is a little bit different in the sense that this is just one instrument, and the beauty, again, as Andrew said, it's one document, it's easy, people can almost kind of fill it out themselves. You need just to be clear, you do need typically a board consent signed before you issue those safes. But the beauty of it is you don't have a maturity date. You don't have interest. The money is in the bank, is in the company.
So what are the moving parts? So you download it from Y Combinator's website, and what do you fill in?
So typically, what you fill in, you have to determine. I mean, the Y Combinator is one, but I mean, they are, of course, they're the ones who actually introduced it back in 2013, I believe. But there's a question about what's the value? Is there a valuation cap and no discount? Or is there a discount but no valuation cap? Or valuation cap and discount? Do you have no valuation cap or discount? All of that. And then there's some other issues like most favored nations and pro rata rights. We can talk about that. But the important thing is clearly, the discount rate, as they define it, needs to be determined. And typically, as Andrew said, 20% is typical if you do that, if you have a discount. Sometimes you choose to say, no, you know what, let's make it very simple. We don't have a discount, as I mentioned. You just have a cap. And you then determine what the cap is. And that's often a negotiation with early stage investors. And some early stage investors have very clear understanding what their metrics are and what they want and how they want it, at what stage, what they want to see, what kind of traction they want to see, or et cetera. But I leave that to you, Andrew. but that's one determination and one negotiation you have to have with your investor.
Yeah. So what ends up happening is that you can quickly, cost effectively, at essentially zero cost, raise money for your startup or get money as an investor into a startup. And you typically have a cap. So the valuation, essentially the pre-money valuation, that dollar amount that you wired will convert to. And if the company raises money at a pre-money valuation below that cap, the discount rate, which is typically 20%, will get you a 20% better deal than people that are investing later, when theoretically it's gone through more milestones and it should be valued higher. But there's no maturity date, which I always viewed as positive. The idea of, I think you should be a big boy, big girl when you invest in an early stage company. You should be prepared to lose it, not have this balloon payment that could destroy the company or prevent it from raising capital. That's my view. But the lack of interest rate removes this sense of urgency, lighting a fuse for them to get to, I want to be on the cap table. And as an investor, I kind of miss the discount. I miss the interest rate a little bit. The other thing is that this is not debt. So in a negative outcome, we all hope that this is the next Google and Facebook. But if anyone with experience knows, some of these things go sideways and some of them go south. So if you invested on a safe note into something that's going south, God help you, you're heading into ABC, administration for the benefit of credit. When you see the Sherwood guys, they come in with like a sickle, like the Grim Reapers, that equity is totally wiped out. Yeah. And it's like that waterfall of senior jet. IRS, they're number one. They're like the private jet that takes off before your commercial airline. After that, it's a who's the senior debt gets paid out from any liquidation of the company. And so if you're on a safe, you get nothing, right? You're pretty much looking at nothing. If you're on a convertible note, you might have been in the waterfall stack of getting something. Is that right?
That is true. I mean, with one little caveat. I mean, so what's become prevalent. So I absolutely agree. So you're not a creditor, right? So if you're not a creditor, you get paid with all the equity, other equity investors. So, but most safes now have like preference language in there, and Y Combinator, by the way, very nicely put that in there as well. Which, by the way, again, is totally fair, because it is a little bit like a blank check preferred. It's a little bit like have some preferences. So you would actually get paid first as a safe holder before anyone else gets paid, like a common stockholder, and the founders get paid. But you're behind the creditors, right? And the creditors are, for example, most importantly, like employees, as an example, they have to get paid first, very high priority. But then also other trade creditors, including law firms and consultants, and AWS, by the way. AWS usually makes most of the money off the startups anyway. But in any event, but you're right, absolutely right.
Venture debt, would be there.
Right.
Absolutely. Venture debt. And so explain why, what happened with all these startups had so many safes out there. And then when conversion happened, there was a little bit of a sticker shock. How do we end up getting post-money safes?
Yeah, no, you're absolutely right. See, this is the interesting part of the marketplace, the safe market world, and marketplace, if you will, right? And you are kicking the can down the road so many times, like when you do these safes. And it's beautiful. And I also agree. I think keeping transactional costs low is so important in the beginning. You need to build a company. That's the most important thing. That's where your money should go. However, if you have all these safes that are converting on a pre-money out there, it almost becomes like this dangling thing, like it's almost stochastic modeling where you have potentially different types of safes out there. They sometimes have most favored nations clauses. We can talk about that a little bit later. They have all kinds of different types of caps or a discount. And all of a sudden, the actual calculations become really complex. And I mean really complex. I know
it's like circular references and breaking your Excel spreadsheet, right?
Yes. And I know people sometimes they I've even had some clients who get really mad. Oh, this must be easy. Everyone knows how to do that. Safes or so. It's like, well, okay, be my guest. Look at this, look at our spreadsheet, and we'll walk you through it. It can be very complex and very difficult. And it ended up being, as you said, Andrew, like a real problem for investors, because you really don't know what you're getting anymore, right? You're kind of sort of stuck in this limbo situation where if someone asks you, where would I end up? Where should I end up on the cap table? Everything has to do with the terms of the new preferred, that, the new equity round that's coming in. What do they say, for example? And what kind of unallocated option pool do they put in place? And there's all these different things, iterations that you need to go through to get there. So ultimately, why did we end up, as you said, with a post-money safe? Probably mostly because of that. And it's usually, in most circumstances, much better for investors. But it also is fair, I mean, to some extent, that the investors kind of know where they end up. In particular, because these safe financing became a little bit of a bazaar of sorts, in the sense that people thought oh, I'm going to give this person this kind of discount and this discount in those terms. Yep. And we ended up, I think, I had one situation where we literally ended up with 10 different series of Series Seed 1, Series Seed 2, Series Seed 3, Series Seed 4, right. All these different and very complex, and ultimately, of course, kind of ridiculous, almost how our certificate looked. And that is why we ended up with these post-money safes, and they're much easier. Now there can still be complications, to be clear, because depends a little bit on what is included and what's not, and especially it can be complicated. I don't want to make it too complicated if you also have convertible notes. Sometimes some companies raise both safes and notes.
Absolutely, that's very common. Like if the investor says I hate safes, and you basically agree with them, like get them in on the note. That's take their money. It's not Al Qaeda. Take the money, and they don't want. A lot of people just don't do safes,
Right.
meaning investors.
Right.
Yeah.
And then, as I mentioned, if you have a most favored nations clause, which basically means that you get the best terms that are out there that anyone else got, then all of a sudden it's almost like a ratchet for some of those investors to get those terms, the terms that would be better, which again affects, of course, the conversion rate and affects the ultimate outcome for the entrepreneurs. And who's gonna pay for it, of course, ultimately, most likely is the common holders, the founders. So I think the clarity is important, and I think when Y Combinator adjusted their safes with very clear language that these are all post money pretty much now, it made investing easier.
I think that from the perspective of the founder and the perspective of incumbent investors and the perspective of a new entering investor coming in the most latest financing, to not know how much the founders and the ESOP own of the company, that having uncertainty around that is not good. You kind of want to know, and I refer to what the investors own as dead weight in the cap table. So I'm going to tell you how great a VC and I add value. But at the end of the day, I call it dead weight in the cap table, and how much do the founders and the employee stock option pool, ESOP, own on a fully diluted basis, which is not always easy to have certainty around what fully diluted truly is. But if you see too much dead weight in the cap table, that new investor might say, hey, you may think it's taken you 10 years to get here. Now that I've shown up, there's going to be at least 5 or 7 more financings. And if there's not enough inventory for like founders essentially to be selling, they end up re-upping the ESOP. And sometimes, you said it comes out of the founder. It's coming out of me before. Like we've had to take the hit to satisfy a new investor. And so the lack of knowledge from the investor side, incumbent, new, and founders on who owns what is problematic. And the post-money safe brought a little more clarity, into that. Now, I want to talk about QSBS. So QSBS is qualified small business tax treatment, where you pay 0 income or even capital gains tax to the federal government on your gain. So, investors are seeking to ultimately buy low, sell high, and make a gain. That's why they're doing this. And you typically pay 0 tax on the first 10 million a gain, or 10x your cost. So if I put $5 million into an early stage startup that meets the test of QSBS, and I don't want to make this a QSBS episode.
Sure. Thank you.
That if I hold the stock for 5 years and a day, then I pay 0 tax on my first 50 million of gain if I put 5 million in. Now, if I invest on a convertible note instrument, does the clock start ticking? So I have to hold for 5 years and a day to pay no tax, right? Do I get QSBS when I invest in a convertible note, or how does that work?
So no, actually, so I understand that it really only happens upon conversion. Now with the safe, that's different. The safe actually does give you can tack back to the time when you actually pay, when the company had constructive possession of those funds.
And are we 100% sure about that? Like, first of all, I firmly believe that if I invested on a simple agreement for future equity, there's no interest rate, it's not a debt instrument, there's no redemption with a maturity date of it, that the clock of 5 years and a day should start ticking from the minute from the date that I wire the money. I would hate to be sitting in a jail cell with Wesley Snipes for not, or I would hate to face a clawback, right? Because the IRS said it was future equity, not real equity. Are we 100% bulletproof that when we invest on safes, we're good to go for starting the clock on 5 years with QSBS?
Well, that is a good question. We are, I believe that Silicon Valley generally takes that position. And I think we have been, and I have not heard of any challenges, but also let's to be clear, QSBS hasn't been around for a long time. It was actually implemented, I think, in 2011, but the first QSBS stock became QSBS stock and of the liquidity events in 2016. So I don't think there are any cases on this. And I'm also not a tax professional. so I have to be
but you can clearly say that comparing
100%.
convertible notes to safes, in general, I think safes are not great for investors, but having QSBS assured
Absolutely
is pretty good. And I've seen startups just raise convertible notes that we got in on, and then safe, and convertible note plus safe. And I'm like, I'm in this thing for 7 years and I haven't started the clock ticking on my qualified small business stock exemption, which is upsetting to me.
Yeah, that's true. And just clarification. So there's zero tax for federal purposes, right? So if you're in a state like California, where I am,
or New Jersey,
you're still going to pay income tax,
which is probably anti-constitutional. So New Jersey, like, I think that when you go to get gas in a gas station, they still have like a dude putting the gas in your car. Like, their idea is like, East Germany, the old DDR, if we're going to get full employment going here, like 18 people to check your coat in the opera in East Berlin. Whereas they say if the jobs are created here in the Garden State of New Jersey, then, the QSBS is good to go. But if you're making jobs in San Mateo and you're an LP in my fund and you live in New Jersey, you got to pay state tax, but no federal. So it's a good break. But, I moved from Silicon Valley to Austin during COVID, and I swear to you, QSBS was a major reason.
I think for investors, I think that's what we heard a lot from a lot of people. Of course, also why people are moving to Miami and other places is because of that. Clearly, no. I mean, I'm going to leave it out there. I don't know if it's constitutional or not, but I know that you will get taxed here.
That's right. Yeah.
So you're right.
Don't think you're going to get to the Supreme Court on it. Just pay the tax and enjoy, hiking around Half Moon Bay on the weekend.
Yeah, exactly.
Yeah.
But you're right. But it is a huge incentive, and QSBS stock has huge implications. And as you know, companies are asked to give qualified small business stock representations in the standard NBCA style documents, and it's a very important part of the basis for investments in early stage companies because of that, and then also because you could. And I don't want to make this a tax, certainly, because I'm not qualified enough to do that. But you can even certainly roll over some of that early, like qualified small business stock into other investments, which is
you can tax. So if you made it to like 4 years and the exit comes, you can take your exit consideration, put it into another QSBS deal, and tack. And then a year in, now you're paying no tax other than California, New Jersey, if you're cool enough to live in those two places. I want to talk about, we're going to have another episode that goes into all the terms on priced rounds, like a Series A typical or late C that is a priced equity financing. But those have, there's the terms that are like the financial things, the valuation and stuff. And then there's all the governance side of like, we're appointing a board seat and board of directors, stuff that I generally call governance. In your experience, Daniel, when you see your clients or startups in the Valley doing convertible notes and safes, do you see the governance portion? I mean, it's certainly not in the document. So we're kind of missing something there.
No, you're right. I mean, frankly, that is one of the reasons also why some maybe more conservative investors, and we see it a lot from foreign investors out of Asia or Europe, they don't like that fact, right? That they don't have there's no governance around safes typically. And what that means, to your point, there's no voting agreement. And typically in the voting agreement, there's standard, which is the customary agreement under the NBCA documents, it would have specific designation rights for the investors. So if you're the lead investor, you typically get a board seat, and that would actually be legislated in that in the voting agreement. There is no voting agreement that comes along with a safe. However, what you can and what you do see often is what we call side letters and pro rata rights.
And
Like,
before we get into side letters,
yep.
I just want to say, like, I recently had an experience where there was a shareholder vote on keeping the CEO or firing the CEO. And, I hate to see this stuff happen, but there's a big Silicon Valley investor who we brought in after us, who had invested on a safe, and their votes counted for zero. They had zero. So the safe holder, the safe investor, had no voting rights. And had they had voting rights, we would have preferred the outcome.
And to be clear, Andrew, I mean, so it's really interesting because if you go back, and we don't do those types of deals, but let's say you have a big restructuring deal and you have sort of senior debt that's coming on top, or you have a bank sometimes even, right? There is a possibility they could actually negotiate for those rights. You could actually have someone literally sitting there in the board, and maybe, beyond that, there are other rights, like, for example, certain veto rights that they may have on their covenants, for covenants compliance, right? But even without that, so I think that unless you have very sort of sophisticated covenant compliance and maybe additional governance rights, you don't really have anything. And you're right, the safes they are simple, right? That's why they're called simple agreement, I guess. They don't have any of that. And the beauty of it is, like, because they're designed for startups, right? They're not trying to employ more mechanisms to, like, control the company and get operational or try to have certain veto rights. But in certain situations, especially when the safes become like this mechanism where people raise a lot of money on, like this stuff that people would usually do in equity financings, then it's a problem.
I think it's perverted. Like a 15 million uncapped safe, it's like, and there'd be no governance, no voting rights. 15 million, we can afford, as experience and as much as you deserve a high hourly rate there, Daniel, we can afford you if it's a $15 million round, is what I'm thinking.
No, I mean, Andrew, we're seeing this.
Question for you, because we're going to run out of time eventually here, is before talking about side letter agreements and, having the side letter be a proxy for all of the good stuff that was happening that is positive, of a well-run venture financed company with a priced equity financing, conversion on a convertible note. So sometimes you have a feature that says if the company is acquired in advance of the bona fide financing that triggered conversion, that'll automatically convert the debt into equity at the cap, or it's not happening, or it's got a change of control premium that the principal gets hit. What are you seeing there, and it's hard to recommend because, you got all sides trying to hire you, but what do you think about these control, change, conversion? So we're talking about what happens if the company gets acquired before the financing. And I've heard idiot VCs say, oh, that never happens. Well, if you live long enough, it will happen.
It will happen. It happens, and I've had it happen many times. And I totally agree with you. I mean, let's be, out of fairness, I think it's totally ridiculous to think. Let me just say, let's say you don't even have a discount, right? Let's say someone gives you the note because, hey, they want to bridge you to the next financing. And then lo and behold, you get sold. So your big payday is to get your money back plus interest. I mean, that's ridiculous, right? That would be
it's happened to me. It's happened to me. Okay, I was furious.
You have to hire better lawyers. I'm joking.
I do.
But you're right. It is actually infuriating to see that, because someone helps you to get to an exit, and then you get your interest. And sometimes, you said 6%, but sometimes we saw as low as 3%. And
I've seen illegal. I said I've seen illegal percentage rates.
Yeah.
Meaning it doesn't qualify as debt.
Yeah, no, you're right. So you have all of that. So why? So what do you do? Yeah, you have a premium typically. And the most common feature, because it's so simple, is just to give someone twice their money back. Right. So just to say a 2x, like, if you will, like not twice the money back.
I think Dave McClure came up with KISS, which was, I forget what the acronym stands. It's like keep it simple, like you idiot or something. It's like Dave McClure had like keep it simple KISS as his convertible note, which was, we all liked it more than the safes. Yeah. And I think he had a 2 or 3x premium. So he basically was fitting a liquidation preference,
Yes.
which you get in, typically there is some sort of participating, non-participating preferred liquidation preference in a equity financing, that he had like a change of control premium. So if you put in $100,000,
Yes.
you would get $300,000 back plus the interest on the 100.
Yeah.
Non-interest on the 3, or I can't remember if it was 2x or 3x, but I
I
remember thinking,
for
good for you,
I would
Dave.
say 2x. We see 2x more. I mean, the 2x, if you will, like 100% premium on top. That's kind of what we see a lot. And sometimes we see even only 50% premium.
I've had 50% plus interest.
Yeah.
Yeah.
So it depends a little bit. It's obviously negotiable, right? But it is, I think it is a fair term to ask. And I think actually, if you're not asking, I would say it's almost like you're leaving stuff on the table. You should be asking for that. And the other feature would be, I think you alluded to it, would be to convert and to allow conversion, and what we call an optional conversion. And that feature is also very common, that because that you say, hey, wait a minute, why should I only get 2x, 2 times my money, or why should I get 2x on whatever I put in? I should get the benefit of, if my money helps you sell the company for a lot of money, I should be able to convert on a particular valuation. And that's also quite common.
That is common. I mean, like I think that the language says that the investor gets to decide if they want to be paid the 2x premium or convert at the cap. And, you have a real lawyer like you run the numbers, which may come out differently. Like, oh, they put an ESOP on me afterwards. The employee stock option pool come in later. I thought I was converting at 10. I'm converting at 25. How in the hell did that happen? But it does. So I think that is something that's good. I guess in the safe, you are converted in an exit, or are you not? That you are, right?
Yeah, you would be converted. Yeah. So
it's a little more secure that you're on the cap table.
Yeah, it's the same thing. So there is a conversion feature that basically would typically, if there's a cap, that would convert you. Either. So I mean, again, you can be very complicated depending on when the safe was put in, right? So if the safe was put in after an equity round, sometimes you could actually convert into the latest round that happened before, if that's better, or at a particular valuation. And sometimes and sometimes it's also a premium. It's just basically like a 2x on whatever you put in. So there is some negotiation on that, but the most common feature would be if there's a valuation cap to be able to convert on the valuation cap and get that payout at that point.
And I want to close on side letter agreements. But one thing that is, I think a lot of investors don't know until they've lived through it, is that a lot of investors say, I'm going to invest in 20, 35 companies, be diversified, so I'm safe. And then I'm going to double down on my winners. And they think, do I have a pro rata equity right? So one of the terms that you get in a bona fide financing, equity financing, is the right to maintain your ownership percentage by investing in future financings. So if somebody rough like Sequoia comes up and says, our fund is so big and we don't work all that much, I want the whole round. And we're like, well, we have this pro rata equity right, so you have to let me put 10 million in because I'm in, it's such an early valuation. And they're like, we don't want you putting in 10. I'm like, well, you're going to have to let me in because I have a pro rata. When you convert, that's only the point at which you're getting. So you might miss the double down round that you wanted.
Yeah.
So explain that.
No, I mean, you're right. I mean, side letters can be very tricky, right? So people say, sometimes clients call me and say to me, they're looking for a standard side letter. I'm like, well, there is a standard side. There are some standard side letters. There's a pro rata rights letter that also Y Combinator put out. They put one out for lead investors. Again, be careful also, who do you give it to? Should you only give it to your most important, like the lead whatever lead, there's usually no lead.
Major investor rights kind of thing, right?
Yeah. But there are certain early stage investors who are asking for a pro rata rights agreement. And it's really important. I mean, the devil's in the detail. So first of all, there are sometimes actual sort of dollar amounts, like not pro rata, where people say in the side letter, I want to be able to invest at least $2 million, as you said, right? Well, that's different from a pro rata, because a pro rata then again is a question of, is it a pro rata against the other money that's come in on the safe? Like, for example, if there's a total round of, let's just say $1 million in safes, and this particular major investor had put in 250,000, does that mean they get 200, like a quarter? Like, for example, it could be, is it a quarter of the round, the next round, or is it just an additional, so they can keep the same amount after conversion? And that can be really complicated, frankly, because it depends on like what kind of formula you put into that, and say, and I don't want to say, I don't make it too complicated, but I think, not only is it almost like a little bit of a circular reference often, but you have to figure out, when does it terminate? For example, the side letter, if the side letter gives you a pro rata right, but then terminates on that initial round, your your pro rata right is gone as an investor, right? It says that this terminates upon the first, after the first round of funding. Sometimes some investors are savvy enough to say, no, I want to have this forever, because I got dry powder. I'm going to put more money in later if I want to, or they could negotiate that and really hold the line when the financing documents are done, the equity financing documents are done, where they have a very specific right that's put into the agreement, or, sort of, and they have a special amendment right, even, not only in the agreement, but then also, if you want to amend this provision, you have to come back to me. So that is sometimes a source of a lot of negotiations. And again, to your point, especially, let's say you have pre-money safes, a lot of pre-money safes, and you got a couple of pro rata holders, and some people have like actual dollar amount rights, they can put in. All of a sudden, your next round could be a very complicated round, and it would really require the new investor to really hold the line, and maybe sometimes put down the law and say, like, no, we're not
I'm ripping up your pro ratas. Yeah,
exactly.
What you see with Sequoia is that they say, I don't care about your pro rata. Do the deal with someone else. I have a minimum ownership target percentage of 20% of the company. So, and if all you little people with your little lawyers or your big lawyers come in and push me, I'm not going to do the deal, because I don't want to own 8% and take 2 board seats of this business. I want to own 20% and get up to 33. So we're just going to walk away. What are the key, what are some things that you see in side letter agreements where you're trying to kind of have a proxy to get major investor rights? And what is MFN, most favored nation? And I think we should probably wrap after that, because I know you don't have me on the clock yet, but
yeah, exactly. So major investor rights are usually pretty clearly defined in a investor rights agreement, and they usually mean information rights. They mean so either quarterly financials, or usually you don't require people to get audited financials in the beginning, because it's just way too intense. But but those side letters, the reason why we have these side letters, by the way, is not just to get a really good look at what's happening in the company, but sometimes you have to, especially if you're an investor and you are taking money from, for example, a pension fund, and they're covered, these are covered securities, meaning like you ultimately have to comply with what's called ERISA laws. I mean, I won't get too much into details there, but in those circumstances, you actually have to be able to do a lot more. You have to have certain management rights in the company. You have to be able to talk to management, etc. So that's one. But most favored nations is really a thorn in every lawyer's side, right? Because, I mean, certainly also the entrepreneurs, but it's really can be very difficult to interpret sometimes. What is better, right? But sometimes it's very clear. Sometimes, let's say, you, Andrew, like, company is super hot. You think, hey, I'm going to put a 10 million cap on my safe, post money cap on my safe. And now, ultimately, like, things are tough. It's tough going. They raise money on a 6 million with a 6 million cap, a new safe with a 6 million cap. Well, if you have a most favored nations clause in your safe, or a side letter, then you should be able to get the better terms. Or if there's a new round in the future that has, for example, a 3x payout on an M&A and you only have a 2x payout on an M&A, that's a better term. You should get that, right? So that's why for an investor, frankly, it's a smart thing to ask for. It's not always something you want to give to everyone, but I think it's a little bit of a sweetener maybe for a lead investor or for someone who like the biggest safe investors to say to bring them in as an anchor. So yeah, I mean, but I would say as company counsel, it's like, if you don't ask, you will not receive, right? If you're not going to ask for it, nobody's going to give it to you.
Yeah, I think that the key side letter stuff, and this is not an exhaustive list that I really thought through, but I want pro rata, I want information rights minimum, and I want to see some level of governance. We once had a CEO that we backed get pushed out by the employees, and a very young guy was like 24 years old, borrowed money from a crypto whale, which we later found out was Sam Bankman-Fried. And Sam Bankman-Fried lent this guy $15 million, and he paid off me, our fund, Graycroft, Tim Draper, Adam Draper, Fen Bougie, all these major investors. He paid us off. We got a 1.5x premium plus the 6%. So it's like 1.68, return on a company that 30x revenue. So we should have been looking at a minimum of 30x return. Wow. And then we found out that Sam Bankman-Fried had lent him money to buy a villa in the Bahamas. And so like, this guy's going to be 50 before he stops talking to lawyers, to stay out of jail. But like, it was just, I just thought I'd close on an example of like, I honestly wish that had been a priced round, and don't give this available option of just pay us all out and be discommunicated from the venture capital and, community,
I mean, you definitely have to look at the terms of each convertible instrument that you're signing as an investor. Yes. Sometimes, of course, it's just, so hot, you just do whatever you
Well, and also like Graycroft was the lead. I mean, I read it. It didn't occur to me that my CEO would get pushed out and I'd be dealing with a new person that's like, belongs in a bunker next to Adolf Hitler or whatever, So, he did what he did, and, we'll never fund him again. But, it makes me think twice about, this conversion at least being a McClure, give me, 2x, and give us the right, I don't know. I think that these convertible notes and safes are really meant to be priced rounds. We just don't want to lose time and money. So closing question, and I promise we'll end here. What if the answer from every lawyer is always going to be, it depends, but give me a clear, if everything is simple, there's no redlining back and forth and people just fill in the blanks, what is the cost of closing a vanilla equity financing for a really early stage company that doesn't even have, a truck train load of weird safes and notes? How cheaply can you do a priced round? It depends.
I would say it always depends, but no, I think if the terms, all the convertible instruments are the same, right? If there's not a ton of back and forth, and if there is reasonable counsel on the other side, I would say the lowest thing I would say is probably like 25K. That's typically where I end up. Now, but again, that really means there's not a lot of negotiation. There's also not a lot of time spent on, for example, a disclosure schedule and those types of things. And companies can keep the costs down if they have someone inside who's really focusing on all of this. Like, even setting up DocuSigns, it could take a lot of time. Even if I push it all the way down to a secretary or a paralegal, but it still takes time to get it all done. So that's probably the biggest. But I think the thing that drives up things the most is if the company's disorganized, and it's almost like a red flag for the other side. They start then looking all of a sudden, like, look at everything, no stone unturned, ask for a lot of questions, ask for changes in the documents, because let's say you had all single trigger, I'm just an example, you had put all single trigger into your founder agreements, investors find out about it or see it, they say, oh, we have to change all the documents. these are the things that anything that you did and skeletons in the closet, and things that were unreasonable in the beginning come back to haunt you. And one point, as you mentioned earlier, if you have like 5 or 10 different pre-money safes with different terms out there, it'll be, a multiple from what I just said. It can be just really, it can be just get very expensive, unfortunately.
Yeah. And so if a company is relatively new, so there's just not that much due diligence or change, and the pre-seed investor says, I want to do $1 million and I want to own 15% of the company, even though you haven't done anything yet.
Okay.
So if 25K is the bare absolute minimum and things are kind of streamlined, like say some seed investor who just does equity only and they're like the first check in, what's the higher end? So you said 25K could be 250, but what sort of a range so people can think about price round cost?
Yeah, I think, probably a round like that should be done for less than 50 for sure. That's perspective. But I would say one indicator often, and it's kind of weird how you back yourself into these numbers. One indicator is often, like if there's a reimbursement for the investors for $25,000, you can almost double or triple that every single time, just because the investors don't do very much. Like, I would say the investor council doesn't do as much because they just ask questions and they throw up their, say this needs to be changed, that needs to be changed. These are comments. Someone has to actually do it on the company side, and that's sometimes the problem. And sometimes, by the way, I am not opposed. I think maybe you too, as an investor, I'm not opposed to have a rigorous due diligence process, because it really helps early on ferret out some of the issues that you had, some of the maybe mistakes that were made early on. And the last thing you want, and trust me, I have unfortunately been there, you get to the Series B or the Series C, and all of a sudden someone is doing a real due diligence and you have real holes in your IP assignments, or other little skeletons in the closet, or you did an early, all of a sudden something comes out, like you took out an early co-founder, and that co-founder is now licking blood and sent a letter and nobody told anyone about it.
It's going to come out right before an IPO and cost dearly. Yeah. I agree. I think that the whole Sam Bankman-Fried crypto thing is an illustration of no governance, no oversight. Teenage investors from South Korea. What did you expect? And if you can bring a level of professionalism to early stage investing, we certainly have a lot of it. There's a lot of people, this is what they do, and they're pros. That's their only job. They have LPs, fiduciary responsibility. It'd be nice to see some 25, 50K priced rounds done and everybody is aligned and you're built to do this correctly, as opposed to we couldn't agree on valuation. That kind of ended by the late 90s, if you asked me. And uncapped notes. There's a reason for uncapped notes. If it's a bridge to something, like Sequoia's coming in, they will never let you in, guys, let's get you in now. And it's uncapped. There's times when I actually would do it, but in general, as a proxy for, you don't want to be the Lady Gaga who diluted yourself by adding value. But listen, it's fun to see it evolve. There's never going to be a shortage with all the AI in the world for lawyers like yourself, Daniel. So thank you so much for coming on, and hope to see you and talk to you soon.
Yeah, me too. Thanks a lot, Andrew. Appreciate it.
Okay. Bye for now.